along to the Q4 25 webinar. My name's Luke Laretive. I'm here with my colleague Ben Richards. We're the two portfolio managers for the Seneca Australian Shares Fund and the Seneca Australian Small Companies Fund. For those who have been coming to these for a few quarters now, we're going to tweak this format a little bit and see if it works. So for those long-suffering attendees, if you've got any feedback or thoughts about this new format, just let us know, drop me an email, and we'll try and keep improving it. So we're going to focus on the two direct sort of Australian share strategies. Then we'll quickly run through the multi-manager stuff, get into questions at the end. As people know, we run these every quarter, and it's fairly informal. There's a Q&A thing that you can use. So stick your questions in there. Larissa will moderate them, and we'll get to what we get to. Ben and I manage these two strategies that invest in Australian listed companies. We're sort of responsible for the security selection, portfolio construction, and ultimately the performance. The Seneca Australian Shares strategy, that's been available as an SMA on the Premium platform for coming up 6 years now. And from Jan 1, we launched that as a unitised wholesale managed fund. So both products are the same. They invest in the same strategy, do the same things, but one's just as an SMA, which has been around a while, and the new product is just a unit trust, not dissimilar to the Small Companies Fund. The Small Companies Fund, people know about. That's also just a wholesale managed fund that you can buy units in once a month. Whilst we operate these portfolios every day, every month we've got to go to investment committee and kind of explain ourselves and justify what we're doing, and the rationale behind why we've made or not made certain decisions. So whilst it is Ben and I doing the day-to-day stuff, we do have some pretty stringent oversight and some nice governance processes, I think, that result in probably the best possible outcome for people. All right, let's get started. Seneca Shares SMA, that closed the calendar year up 16.75%, which was 6.5% ahead of benchmark. Puts it right up there among the top handful of products in the peer group. Strategy's been running since 2020 now. It's generated 11.85% per annum returns for the period since inception. And January we added a bit more than 2%, so ahead of benchmark again in January. We sort of continue to generate, returns from really company-specific ideas and catalysts kind of across the sort of sectors. We're not really in a sector or not in a sector. And whilst, we're interested in macro and we read, probably like all of you do, we don't invest to capture themes or, tailwinds that people talk about. It's not really our go. It's pretty simple for us. We just look to find things that the market's undervaluing, buy them, and then wait for the market to value them fairly or maybe even, unfairly high. I think from terms of, what's been working for us, as you can see here, these sort of stock-specific ideas, bit of gold, bit of these sort of other commodities, pro-cyclical commodities, base metals and that sort of thing, as well as a little takeover bid for Monash was helpful. Detractors, rate-sensitive stuff, bond yield-sensitive stuff, as you would expect. We're adding to our energy positions. We've been cutting and trimming gold a little bit and trimming the banks during the quarter. We talk before fees here because 95% of the clients investing in the SMA are my advised clients. They get the product for free and just pay me an advice fee. So to give other people access to the product who don't want me as their advisor or don't want to have an advisor, we have launched this unit trust strategy. Same setup roughly as the small cap fund. It's going to be sort of fee parity with the SMA. By the time you pay the platform and you pay Seneca, you're going to be up to about 75 basis points a year, and that's what we're going to charge for the unit trust. But you don't need to pay a platform. You don't need to pay an advisor to access the strategy. Here, it's got a 50 grand minimum. And look, we're doing the website and some rebranding and stuff at the moment. So website probably not going to be up to date, but if you do want to invest in this product as I have, feel free just to drop us an email or give us a ring, and we'll get that organised for you. In terms of strategy, I suppose, what's happening in the fund and how we're thinking at the moment. Our main thoughts, I suppose, are, tech's been sold off pretty hard. It's now trading kind of, one standard deviation below average valuations. And that sell-off's been driven by kind of rising bond yields with, the much sort of touted inflation story and the RBA raising rates and all that sort of stuff that, is in the paper every day. I think the RBA is forecast now by the markets to raise rates twice more this year, 50 more basis points. And I think this kind of rotation out of sort of traditional growth stocks that benefit from declining inflation, is sort of happening. It's underway. And the growth at any price, in our view, is a recipe to lose money. So we've been focused on trying to find stocks that we think can provide us with a hedge against inflation, and commodities is one of the better parts of the market to find that sort of hedge. I think what you're looking at is just as important. Both the large cap and the small cap strategy are kind of focused on those sort of mid caps and small cap businesses in the market, and that's for a reason. It's because the ASX 20 is overvalued and it's not growing. Certainly not growing as strongly. So I thought this was a pretty good chart from Evans and Partners and worth including. So yeah, this month we're going to cover South 32. It's probably a perfect example of the kind of stock that we're upweighting in the portfolio. Strong balance sheet because they've been selling off some assets. Portfolio is now much more focused around some, generating good returns for shareholders, and it's got exposure to these base metals prices, which are on the move. So I think that's quite a nice idea. And you've got some catalysts from a potential spin-off of the Cannington silver lead zinc mine, which is up in North Queensland, and the ramp up of the Hermosa project over in Arizona, which is also doing sort of said silver, zinc, and lead. So yeah, I mean, that's one of our better ideas, I think, at the moment, and it's having a good day today as well, which is always nice. All right, Benny, talk smalls.
Yeah. So Small Companies Fund has returned 33.4% for the 2025 calendar year. It's 8.9% ahead of benchmark. Returns were pretty much flat in the December quarter, although I note we believe we're ahead of the benchmark in January.
Yeah, we had a good Jan.
So the fund has now been running for 2.5 years. It's right up there in the top handful of small cap funds in the peer group from a performance perspective. Similar to large cap, as Luke said, we're really focused on these company specific catalysts and ideas rather than trying to predict whether the gold price is going to go up, down, sideways tomorrow or the next day to make money. So yeah, it's pretty simple. We're kind of just focusing on finding returns that can outperform kind of through the cycle, I suppose. So yeah, in small caps, we've identified, I suppose, numerous instances of companies that are left unloved by the market, and someone else often ends up recognizing this value disconnect. Monash RBF was one which we own in both funds, as well as kind of, some improving sentiment in the resources sector, not only in gold and the stuff that's dominated the headlines in the paper, but across copper and even energy and some other minerals that have kind of been pretty beaten up and unloved for a while. So yeah, this resources theme or resources sector has been a key driver of outperformance since inception, really. In the last 6-12 months, you'll notice a lot of small cap fund managers that own the same popular stocks, Life 360, GDG, Hub, starting to kind of lag benchmark returns, and partly because that their mandate probably excludes them from investing in the resources sector, which comprises about 30% of the small caps market. So we think that, investing in both resources and industrials can be an advantage through the cycle. So we'll just touch on that resources sector outperformance. So we've seen that again in January. 13% So resources have significantly outperformed industrial companies, led obviously by gold over the last sort of 18 months. But yeah, we think on the long-term chart, like if you zoom that chart out, there's still actually a fair bit of catch up from a resources perspective since, the last few years of underperformance. So one to keep an eye on there. And for this quarter, I thought we'd bring actually an industrial company to the table. It's called Symal. The code is SYL. Symal is a vertically integrated business, construction, contracting, civil remediation services, and equipment hire. Company's got a strong pipeline in data centers, renewables, and in infrastructure development, particularly in the western suburbs of Victoria. So you probably see the Symal branding around if you, like us, are keeping an eye on things down here in Victoria. Stock is tightly held among insiders. It's a founder-led business, led by Joe Bartolo. Strong balance sheet. It did have 46 mil of net cash at the last report. Since then, it's made a couple of acquisitions, which we think look pretty accretive, broadening its service offering and exposure to different geographies. So particularly, we're starting to look at things like the Brisbane Olympics in 2032. So any contractors with exposure in that Queensland market potentially are well placed to pick up some work there. And Symal, we also think it's a fairly recent IPO, so we think it's been pretty inefficiently priced for now. And yeah, it's done pretty well for us. It's contributed nicely to returns in the last couple of months, but as you see on the chart there, it still trades fairly inexpensively on 13 times PE. And yeah, all the peers are kind of on 15 to 30 times. There's just a select few, but yeah, they're pretty consistently trading above where Symal is. So I think there's an opportunity for re-rate as well as earnings growth.
All right, multi-manager stuff. So Seneca operate 5 multi-manager strategies across Aussie equities, global equities, aggressive and defensive income, and liquid alternatives or absolute return. That's run by our investment committee. We sort of run the ruler over those every month, make changes as needed, and kind of all clients, however much they have invested in each one of those products, gets their portfolio updated with our latest views, kind of equally, fairly consistently across the board. So it means that I know that all clients are sort of optimally invested at any given time, regardless of what they're in, whether it's a direct product with us or investing in asset classes where we're not the best people to be running the money direct. This is sort of the new part, I suppose. I'm just going to run through this in one slide. I think point to absolute return, which is, we've had a protracted period of underperformance. We've seen a really good rebound in the trend following strategies that we're invested in. That's continued actually in January as well, and sort of quickly rectified the since inception underperformance numbers, to be honest. So investment committee's ability to kind of look through short-term performance and have a kind of macro strategy there has kind of paid off for investors in that. Which, I'm also an investor in that strategy. So I think it's actually pretty underrated by people. The defensive income strategies continuing just to be like a reliable, low volatility income strategy. It's rarely underperformed or gone backwards since inception. We're continuing to favour sort of, investment grade fixed income exposures here. We're tilted to emerging market debt. And we're exposed to kind of a range of durations. I'd say we're kind of duration neutral in that portfolio. Aggressive income's a sort of blended portfolio of kind of high income equity strategies, as well as sort of investment grade and your sub-investment grade debt. So when equities rally hard as they have, we can have periods of underperformance because we've only ever got kind of maximum 30% exposure to equities in this strategy. The idea, though, is that this thing kind of meets its kind of goals, I suppose, and generates kind of equity-like returns with much lower volatility and risk on the table. And I think, since inception, we've been able to do that. It's had a fine period of performance in the most sort of recent quarter and half, and with just the rip up in equities over the 12 and 24-month periods is why it's behind benchmark along that time frame. But longer term, it's done 6% kind of, which is in this kind of environment kind of what I'd expect it to do. Global equity is kind of our main sort of story, I suppose, and that's because we remain underweight US mega cap technology names, and that's been the whole and sole reason why we've underperformed. We continue to favour emerging markets exposure across kind of Asia, South and Central America, and small and mid cap specialists. Well, I think in the last 3 to 6 months, we've got this macro call right, and emerging markets have actually outperformed US equities by 27% over the last 12 months. The problem is though the two managers we've selected have underperformed. So, we've added in a third manager just recently, kind of diversify away, kept the weight the same, but spread the money across three managers. But we has been discussing this portfolio a lot at investment committee. And the upshot here for investors is we've resolved to persist with us, with the strategy. We think that the gap between global small caps and large caps has closed, but we think that our managers are going to come through with the goods. And we understand that the sort of our performance for any given manager is a little bit cyclical. And the managers we have selected have got a good track record. They run a really good process. They do things properly. So we think that mean reverts in time, and we're going to stick fat with them. Aussie equity is probably another story of apart from us, who we're going quite well. Seneca from an SMA perspective, which is 25% of that portfolio, and the RQI strategy we're investing in is going quite well as well. But the rest of the peer group, up and down. When I did some analysis recently, active managers have had a tough year. DNR, they had negative 2% returns last year. In the same year, we've done almost 17. So, whether it was Spheria, Benelong, First Sentier, X20, some of the other stuff in this portfolio has really been a case of, diversification, dragging our portfolio returns down rather than adding. So investment committee is currently we've kind of resolved the global equity side of things, but we're really focused on this Aussie equity strategy and considering kind of the best ways we know how to address this issue, I suppose, for months ahead. So expect maybe more on that at the next quarterly, a bit more of an update. All right, outlook. It's not that different to probably last quarter. Emerging markets over the US. We think Aussie equities are correlated with emerging market outperformance. So, yep, plenty of that as well. Continue to think smalls are where you want to be relative to large. And as sort of Benny said, these mining in particular, the pro-cyclical side of the mining industry, particularly attractive to us. In fixed income, there's still good yields out there. We're just looking at 10-year bonds in Australia this morning, like 4.85% risk-free rate at the moment. So plenty of income out there, no shortage of yield. Again, sort of prefer these emerging markets, Australia and European/UK bonds over the US. And we don't have a lot of private credit exposure in our portfolio. So for those worried about that, and I think they're worried with good reason, we've got minimal exposure there. From a macro perspective, you guys know about inflation, the RBA yesterday, and I continue to sort of lean on this, inequality and borrowing from the future thematic, which I think is kind of robbing Australia of productivity. On China and stimulus there, and the Chinese economy continues to be the wild card, I suppose, for us, both from a balance of payments perspective and I think inflation in our region. So that's pretty much the outlook. If you want to hear more from us, we do heaps of media. Probably we're in the Fin Review recently. We do the SBS World News, Ausbiz pretty regularly. Equity Mates, Rask, and the podcast kind of circuit, I don't know, once a quarter. And we try and put something up on Livewire for you guys to read about what we're up to every 8 weeks or so. So 4 to 8 weeks. So yeah, plenty of stuff there for you. If you want to keep abreast of it all, I write every week to investors, and you can sign up for that for free. And I usually put any media that we've done during the week in there, so it's kind of a good way to keep track of almost everything. All right, Q&A. Feel free to submit your questions. We'll do our best to answer them. I think we've been spending a lot of time talking about everyone else's portfolio with this Q&A historically, so we're going to try and not do that today. We're happy to talk about how we're investing at the moment, or questions about the way we do things, but we're sort of not going to just be doing a portfolio review for you guys. So yeah, if you've got any questions, stick it in, and I'll try my best to answer them. Let's have a look here. All right, Steve. Corey, in the portfolio, given this week's merger, do you see the share price 70? What happens from here? Yeah, like again, we're not going to be providing, ongoing portfolio commentary. We think that, Corey is fine. We don't have any issues with it. It's still an emerging, evolving position for us. Yeah, we still own it, and we still like it. So nothing's really changed there. It's Q&A. All right. I'm busy, so I'm going to give you another 1 minute to put your questions in the Q&A. Otherwise, I'm going to wrap it. Who's this? Jason. Silver price crash. Price crash might be a bit of a stretch. I think the silver price is still pretty high, and relative to gold, I think it's at, -1 standard deviation ratio. So don't know about silver price crash, but don't have any. Don't have any real opinions on gold prices or silver price. You got anything logical?
We don't own any silver stocks, so that probably tells you our view on silver, other than South 32, which is kind of its own beast.
Yeah, more than one.
We're not punting on the silver juniors, I suppose, if that's your. What's your view on precious metals versus base metals? E.g. SRZ and tin, BBX and bauxite.
What's that view? Precious versus, but why does it have to be versus? That would be my sort of
precious
question. More, my kind of counter question mark is why versus? Like, can't you just own both, or can't you just own exposure to lots of things and not worry about trying to get the thing to buy?
I think I spoke a bit on Ausbiz yesterday about the precious, or I suppose the commodities complex spanning precious and base and that type of thing. But I suppose in terms of your questions on Stellar Resources and Tin and VBX, actually, I think Luke talked about them on Equity Mates, which is maybe where you got that from. But yeah, still like both of them. There's not been really any change to the fundamentals other than share price moves. VBX, I suppose the one point to note is they've been doing some more drilling, extending their resource, upgrading their resource. Still think that looks like a cracker of a resource. It's that kind of top 5 meters of dirt is basically 0 strip ratio, near surface and near port. So continue to like that one.
That's what we call Goldilocks in bulk commodities. So I read the other day in the AFR bullish on minerals again this year. Do you see any opportunity for a successful tech rebound? Yeah, we own plenty of tech stocks. We think there's James, there's plenty of tech in the portfolio. I think there's plenty of undervalued tech businesses out there, and again, we try not to worry about sort of macro or calling sectors or whatever. We're just looking at stocks, mate. So
I think you've got to be selective as well.
Super selective. There's a lot of shit out there.
We're not buying the ATech ETF, for instance. We're looking.
Yeah, we're trying to buy specific companies at ridiculously good valuations. So
probably buying 1 or 2 at the moment. Won't really talk too much about.
Yeah, we've probably got. I think we bought or topped up or bought 5 or 6 tech things in the last week or so. Sam Lyles, thoughts on E-Road pulling up stumps in the US? We like E-Road, and we think that hardware tech is probably the kind of corner that you kind of want to be playing in. We're investing in, we've invested in E-Road from the start for Australia and New Zealand. So I think whether it's Coria, E-Road, any other small business, particularly recurring revenue businesses, if the general vibe is kind of going how you expect it to, you're going to be, much better, not worried about a quarter or a half. So yeah, it's yeah, I'd be much more focused on that. Is there anything in Q&A there?
There's a couple in the chat. We've got a question on how did the small caps fund perform in January? Finalising the numbers
but like yeah, it'll be out 3.5% ahead of benchmark from top of my head after fees, roughly.
Maybe I reckon maybe less than that, but it's ahead of benchmark. And
no, anyway, we'll see. Whatever it is, it was before fees. It was pretty good. We're fair way ahead.
Thanks, guys. Ben, you mentioned Life 360 mandates and energy stocks. It's maybe a question, but super funds don't have mandates to invest in sectors such as fossil fuels. Does that restrict their share price growth potential, regardless of company performance? It's an interesting question, but I think when you think about mandates from big super funds and ETF flows, I think that probably this recent month really shows you that you can't just rely on a greater full theory, because sure, there's not many tech stocks on the ASX that are liquid and large, and WiseTech and Xero have historically traded on premium valuations because of that. But that doesn't stop them getting sold off and trading at a more fair valuation at some point. So it's yeah, I think we don't worry too much about those mandates. Like if you think about coal and oil, we own a couple of stocks in those sectors, and yeah, if you get the cycle right, you get the earnings right, you get the operations right, and you've kind of got a capital allocation framework that's pretty reasonable, I think you're still a good chance at making money in those names.
All right, thanks, Pete, for your commentary there. Pete Latham, one of my favourite internet friends. Are you guys still following Botanics? Yeah, we are. Do you have any views on the company post update? Yeah, we do. We're not going to provide commentary on stuff.
Deep Yellow is also a question.
Deep Yellow, same again. Reg, your position picked up WiseTech. Are you looking to add position in recent sell-off? Same for Xero. Are we a fund manager? Yes. Do we buy and sell shares? Yes. Not interested in telling you what we're doing day to day or week to week. Maybe we're selling it. Maybe we're buying it. Who knows?
Capacity.
Rough timeline.
Fund full. Rough timeline on when it will be full. I think you mentioned a while back getting close to reaching target size.
No, we're not close. I think we'll be at $43 million or something like that at the moment. We think we can run this thing pretty comfortably at $500 million. So no, we're not close to reaching target. I think we are in ongoing discussions with a range of large institutional investors, including industry super, who are pretty, seem pretty interested in what we're doing. So if any of those come to pass, they hand out kind of $200 million plus checks. So that's the situation where, maybe we get to $100 million on our own, and then you get a check from one of those guys, then you will be closing quite quickly. So, I don't see us running this fund any sort of bigger than sort of 750, 800. So that'll be a hard close number. So yeah, soft close, I think around that 500 would be what I'd be thinking about. Thanks. Just wondering, does it get hard? Yeah, it does. It does. And I mean, if you look at any fund that's got $1 billion or more, they're not typically the top performing funds in the sector.
We're certainly going to be thinking about that when the time comes that we think it's starting to get harder. I mean, we've got our own money in the small cap fund, so it's not like we're just trying to. And there's also no management fee on that small caps fund. Don't forget. So it's not like we're in the business of gathering assets and just sitting on it. Some funds might get to $1 billion and just sort of sit there and generate okay returns, but really that's not our game. So we're certainly thinking about it, but yeah, there's not an issue for now.
Yeah, and to be honest, like by the time we get there, we'll be making plenty of money. We will have made plenty of money along the way, and probably Ben and I will have more money than most investors, if not all investors, in the product. So,
cheers. Thanks, Will, for your question.
Yes. So whoever's got the AI, kick that out. Peter Teo, as lithium supply tightens, is lithium on your radar again? Lithium's always on our radar. Like everything's always on our radar. People ask us, do we look at XYZ stock or XYZ sector? We look at everything, like everything, all the time, every day. we're never not looking at things. So yeah, it's on our radar. It was on our radar. $700. It's on our radar. $1,500. On our radar. Where the price it goes to next. So, yeah. All right, guys. That's 1:00.
Yeah, that's all the questions.
80 of you have survived the whole meeting. So I appreciate that. Like I said, if you want to invest in the large fund, the young books on so thank you.
Thanks, guys.